All right, happy Monday. It is the 3rd of August. We're really having this, and really the point of this one, and I guess the theme is the market's moved on. So after last week's Fed meeting, I think a lot of people expected mortgage rates to suddenly improve, and that didn't happen. And honestly, that's the lesson, right? The Fed spoke, market shrugged. The Fed held rates steady after its July meeting, right? And the markets, as widely expected, kind of expected them to do this, and nothing happened. So what we're looking is the Fed governors and the Fed voting members. They're saying inflation's easing, but they're not ready to declare victory. So mortgage rates are still hovering the mid 6% range despite the meeting. And really, people are wanting one Fed meeting to change everything. And that's just not how mortgage rates work. The reason why, of course, is we talked about this last week. I've talked about it quite a bit. Mortgage interest rates are predicated upon the bond market more so than they are with what the Federal Reserve is going to do. The bond market, in turn, is really going to look at our treasuries, to look at economic strength. It's going to look at jobs. It's going to look at our GDP, right? Our gross domestic product was being produced. We're going to look at PCE, which is another inflation the personal consumption expenditure. These are things that really our bond market looks at, and it will reflect things like oil, right? Ever since March, that first week of March, rates just went up and up and up and up. It's not as bad as it was 3 years ago, but still, most folks want rates back in the fives. Maybe a little bit before we get there. I think eventually we'll get there. So keep in mind, the bond market's still in charge. Mortgage rates follow the bond market more closely than the federal funds rate. Treasury yields moved lower as oil prices eased and the Iran tensions cooled slightly. But then again, Friday we saw a little bit of a spike because of things, right? So even with that improvement, rates haven't fallen dramatically. And really, I think the proof is in the pudding, right? Investors still want that proof that inflation is still truly under control. So the bond market really wants evidence, not optimism. It's called being an optimistic pessimist, maybe, right? They want to see the evidence. They want to see it. Seeing is believing. So keep in mind, the real estate market, this question we get a lot, is adapting. Buyers are negotiating again. We're seeing properties listed a little bit longer. We're seeing price reductions, or what most agents that I know call it price improvements. And you're seeing buyers coming in and saying, okay, well, it's been sitting on the market for a month or two. Can you give us a credit towards closing costs? Can you come down in price, right? So seller credits become more and more common. Builders continue to offer incentives. Financing strategy matters more than the lowest rate. Keep that in mind. If you could go in and say, hey, seller, can you buy down my rate? There's even a program for sellers, by the way, that we have called Seller Pre-Lock, where the seller can pre-lock the rate for the buyer that's going to purchase the property. It gets quite low if they want to do that. But it allows them to sell the property for closer to what they'd probably like to sell the property with or for, rather than waiting for someone to offer 3 months down the line, having to pay that mortgage, having it sit on the market, have the listing, as we say, often get stale, come down in price at a larger amount. So a price improvement at $20,000 versus a seller credit at 20,000, two different things. The seller credits usually the better deals. So I'm seeing deals get done because people are solving problems, not because rate selling became amazing. So we're seeing in Star Lending, bank student loans, really, really competitive with interest rates right now. It's incredible. What we call the non-QM loans, so the non-Fannie Mae, Freddie Mac loan types, bank student loans, profit and loss loans. Still, we use underwriting guidelines to underwrite them. Their rates are actually, in a lot of cases, better than the conventional rate. We're seeing DSCR demand, which is the rental property loan, right? So you're using income of the property to help qualify that property loan. So rental property, non-owner occupied property, demand spiking through the roof. Fast underwriting, we're getting deals underwritten in literally 24 to 48 hours most. We're closing transactions in 5 to 7 days. We're getting creative with financing for a lot of self-employed individuals. And there are those buyers who stopped waiting and now they're out there and they're starting to plan. So here's a take. Stop asking where rates will be. Stop asking about interest rates and interest rates and interest rates, whether you're working with me or anybody else. I know they matter, and you'll get something competitive as you work with me or my team, anybody else, right? That's our job, to find you the most competitive thing we can if you're good. But nobody, not the Fed, not Wall Street, not me, can promise rates will be 6 months from now. But we can build a strategy today that works today. It fits your budget, your lifestyle, and you're comfortable with room to refinance when the opportunity comes. So the market's moved beyond the waiting for the Fed. It's adapting. Buyers are adapting. Lenders are adapting. And then people understand today's financing. It works for them. They see the overall investment. They see the return of investment. They see the wise decision of building wealth through real estate. They're finding opportunities. So if you want to find out about any of this stuff, of course, or any questions about any of this, I'm here. Let me know. Shoot me a message. My links are below. Thank you for joining me this week. Have a blessed week.